Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me is Andy Hyer, Client Portfolio Manager with Nasdaq Dorsey, Wright. Andy, it's great to see you again. Welcome back to Trade Talks.
Thanks, Jill. Great to be with you.
And let's talk about SMAs. Tell us what they are and how Dorsey Wright is involved with separately managed accounts.
Sure. Separately managed accounts, or SMAs, have been around since the late 1970s, but it's an area that's really growing. What it is it's exactly what the name would suggest. It's a separately managed account managed by a third-party money manager like us or others. It allows a financial advisor to work with individual clients, build an asset allocation, but to outsource some portion of that asset allocation to a manager to directly, actively manage.
SMAs had a banner 2020. Why is that?
You know, they really have. They've seen significant growth. I think that the latest Cerulli report showed that separately managed accounts were up to 1.4 trillion in assets. That's up about 16 or 17% in 2020. You add another 700 billion in unified managed accounts, and I think those were up about 26% in 2020. So we've seen significant growth across the industry, and I think there are a couple of reasons for that. One, you know, some of the features of separately managed accounts that ultra high net worth investors and high net worth investors have liked for a very long time, they're still there. But I think technology has really made it easier and easier to implement and use separately managed accounts. And I think that's a key driver of that growth.
Andy, how did the deals we saw in the space, like Franklin Templeton acquiring Legg Mason, impact the SMA space?
Yeah, you know, I think it's a good indication. So you take a juggernaut in the mutual fund space like a Franklin Templeton that's out there buying one of the largest separate account managers in Legg Mason, you know, Eaton Vance being acquired by Morgan Stanley and others. I think it just speaks to the fact that people are bullish on the separately managed account space. It's an investment vehicle that's been around for a long time. People like it because of direct security ownership, the customization, a number of different aspects of separately managed accounts. But as technology has really made it easier to open accounts, easier to administer those accounts, easier to do things like unified managed accounts where you can put multiple strategists all in one account. I think there's some very good reasons why we're going to continue to see some very strong growth in the separate account space.
So Andy, with that said, let's get your outlook. Is the growth in the SMA space sustainable?
You know, I think it is. I think there are a number of key drivers that will be strong tailwinds for SMAs going forward. One, I think it's appealing to clients and to financial advisors to be able to use separately managed accounts. For the client, it allows them to be able to get specialized investment strategies they might not be able to get in other investment vehicles. Again, it allows them to have direct security ownership, a number of potential customization. For financial advisors, it allows them to create greater economies of scale. They can build a larger practice. You know, it's hard as a financial advisor to be all things to all people. To be able to bring in a third-party money manager to bring specific strategies to the table with their clients, it can really help all involved. So, you know, I think there are a lot of key drivers that will that bode well for this industry. It's been, you know, for us, we have also seen very strong growth in the Nasdaq Dorsey Wright SMA business. We, you know, it just seems like it's accelerated over the last year or two that we have seen some of these factors come together, and so I'm super excited about where it's going to go.
So Andy, let's wrap with Nasdaq Dorsey Wright specifically. Tell us more about the rationale for using relative strength or momentum as the foundation of the Dorsey Wright investment strategies.
Yeah, you know, there's no shortage of different investment factors, both fundamental and technical, that active money managers can use to manage a portfolio. The more testing that we did over time, the more convinced that we became that relative strength was really the key driver of returns, an area of opportunity for us. And so a number of years ago, we developed a family of accounts called systematic relative strength portfolios that have been really successful. We're really happy with how they've performed over time. They use a very disciplined relative strength approach to managing money in different asset classes. And again, we're happy with what the results have looked like over time. The rationale really comes down to this. So relative strength is a very pragmatic way to invest. It's investing in the market as it actually is, not as we hope it will be or we think it will eventually become. It's dealing with reality as it is and investing in those trends, trying to get into trends relatively early, participate in those trends as long as they remain strong. And I think there's just a lot of advantages to building in relative strength-based strategies as part of the client's asset allocation.
All right, Andy, appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thank you.